Hey everybody, welcome back. We have the 4350 level, which is becoming very significant. We can see right here where we closed. I have this level at 4330, which is going to be the wick right here. When we've been flipping over that, we've held 1, 2, and it looks like we're holding 3 weekly times there. We're going to have to watch this really closely, but you definitely have a little bit of a battle going on, as we're going to see as we drill into this a little closer and start really getting into some of this data. We're going to get pretty deep dive today in what's driving us. We're going to talk about the war a little bit. We have to get into some economic data, look at what hedge funds are doing with the dollar. We have to talk about the bond market, and then we're seeing another rotation, and we have to discuss that rotation and the probability that it's going to continue, because I think that's where the money's going to be. It's going to be in the rotation of sector more than directional right now. We're not really going anywhere, and I think that's a really important distinction. For example, if you just take a look at where we are now, and then you just come across, I mean, if you really look at it from about June, July, where have we really gone in 2 years? Well, up and down, but at the end of the day, we're in the same exact spot. So we're not seeing a lot there. And I think there's a really important lesson to take from this. If I take my line and I just drop it straight across, what are we seeing? Well, we're just really seeing a reversion to the mean, meaning we overexcited and then overly pessimistic. And now what's happening? Now we're just kind of going to that level. In other words, here you are, you're completely over pessimistic. This is when the CPI, actually inflation, spiked. This is when everybody was going to be rich with JPEGs and we were all going to trade them with one another, and it was the future. And now you can see that right here, what is happening. We're just leveling off. Now, it's always interesting to me to take 2 data points and just click on them and just drop a 50% line and see where that 50% line lands. And I think that 4160 is pretty fascinating when you measure from here to here. And you'll say, why? Well, this is why it's fascinating. If you go here and go left shoulder, head, right shoulder over there, you have a neckline, and I'm sure you guys already saw that, but look at how you battled that area. So where could we get to? So for me, let's say that we break up here. This line, to me, this 50% retracement line really is where I think that we could go or test if we break here, which is roughly about 200 points, and that would put us here. Now, at the beginning of the year, I've been fairly bullish on the market as a whole. I still feel that way, even though we have 2 world wars right now, or the potential for, quote, world wars. We have the proxy war with Russia that's going through Ukraine right now, obviously, and now we have what's going on in Israel. We're going to have to address this today and what it means going forward. And I think that that's everybody's larger concern, because as uncertainty picks up, we have risk premium. What risk premium is going to do is risk premium is going to drop us down, meaning if there's too much risk, the market's just going to drop. It's just the way it is, and people are going to buy the 10-year. Now, we'll talk about the 10-year. What's fascinating to me is, as much as we're talking about these bond auctions, and now everybody is a bond auction expert, what we're seeing here, no matter how we want to look at it on the week, is they bought bonds. We can say anything we want about the bond market right now. It's bad. We need to get it. We need to get out of it. These auctions are awful. We're going up to 5.25%. No matter what we say at the end of the day, the previous day, if we look over here at the data and we just take a look and say, okay, at the end of the day, we closed at 478. We're at 462 on the week. So we rallied. People bought the 10-year overall in the week. And I'm going to just suggest to everybody that they start looking at the 10-year on a weekly basis and saying, are we up or down? Do we have net buyers or sellers on the week? I think that there's a differentiation here. Now, if you take a look from September on, we've had nothing but net sellers, and now we're getting nothing but net buyers. So how long does that go on for? I don't have a clue. I do know that if I was to look at this and say, well, where could we get to? 434, that might be interesting to see if we could test there. I don't know if we're going to test there or not. Nobody knows that. But I would be looking to see if we're going to get down there. And if we do, then what happens to the equity markets? Well, then the equity markets will start being able to price in more of what? They'll be able to price in more of a risk premium. And if they can, then that means that we should go higher. I still think, and with everything going on, I still think it's possible that we take out the highs on the year. I felt way more comfortable about that statement before we had what's going on with Israel, and we're going to have to address this and the possibility of the spread. And there's some really smart people out there that are experts in this, and what they're saying is not ideal, and we're going to address it. But we have to watch this 4351, and then we have to realize that if that breaks, the easiest demarcation line for me is going to be right in here at that 4160, and then go from there. Now, if we just use the slightest of indicators, and we note that the 55 is still pointing down, And I want to be real clear about this, that we flip to a day. You can always tell what chart I'm looking at right here, because I'll have the day right there, W's for week, you get it. So you start seeing other 55 sloping down. That's not ideal. The fact that we rejected the 22, I'll say it again, that's not ideal. Now we need to hold in here, but as everybody is aware, these are demarcation lines for me. If you're not aware, these are demarcation lines for me. And the way that I view them is this. We'll go through them line by line. If I look at a 55 SMA, I use a 55, a 12, and a 22. You should use what's comfortable for you. If I use this is where I have institutional sponsorship, 55. And what that means to me is everybody here, I look at the world and say institutions are no longer interested. Well, do I really want to be extremely long if institutions are not interested in the S&P? Probably not. Where was it easier for us to make money? When institutions were interested in the S&P. When has your performance really struggled and then you're trying to reevaluate everything? When institutions are not interested in the S&P. It's not rocket science, guys. Using something as simplistic as this can save you a lot of aggravation. And it does for me because I change my trading style predicated upon a bunch of metrics. This is one of those metrics that I use to change my style. But if we understand that we're going to use that for institutional sponsorship, and then we take a look and we go 22, well, what would we use the 22 for? I use it as determining who's in charge, meaning are bulls in charge or bears in charge? How has trading been since we've broken under that level? Well, it's been pretty bearish and it's been pretty tough for most people that aren't used to using these kinds of demarcation lines. You've gotten here, you've rallied a little bit, started feeling pretty good about yourself, and then the last 3 days, you're wondering what you're doing. Now, if I look at this and say, we tried to flip, I need 3 to 5 days over any one of my metrics. This is how I view the world. You can view it however you want. I need 3 to 5 days over any one of these lines to change my thesis. 3 to 5 days over to change my thesis. So 1, 2, Matumboed. Right? Did not happen. Here we are. Who's in charge? Bears are in charge. Deal with it. That's how I look at it. Do I want to swing trade or not swing trade? If I'm above, I will hold trades for longer periods of time. When I get below this, I am day trading. So if you're in the community, you already know this. When we're in this period of time, I will hear that all we're doing are short-term trades, or we're starting to do way longer-term trades. Yes, completely changes here. Anytime I'm below the 12, and you go look at your own trading journal, anytime you're below the 12, you will note that your long swing trades do not work as well. That's how I view the world, and I would suggest that you come up with a methodology, whether or not it's mine or not, that you have a way of viewing the world that is objective. When I say the world, I refer to the S&P and looking at it, but I do it with all the indexes. I do it with stocks, different with stocks. I can do that at another time. Comment below if you want me to walk through that. But here we are in the 50, we're rolling. So I worked off the oversold. I got back to a neutral stance on the RSI and I'm stopping. I've seen things look ideal before. This is not what ideal looks like. And so this is something that we're gonna have to deal with. Lots of comments about spending a lot of time on the S&P. Yeah, I am. Because you're in one big trade, right? If you have 2 global wars going on, you're dealing with crude oil. You're dealing with all these different variables. We're dealing with the dollar, which we're going to get into. You're dealing with the 10-year. You need to understand what the global market's doing. My entire way of trading is top down. It's how I was trained. So I look at it and I go index, then I go sector, then I go stock. Index, sector, stock. And the reason that I do it that way is because that's how institutions look at money. You can either learn how to trade like a day trader, which is very retail in your thinking, or you could learn how to overlay how institutions and people that manage real money trade, and you can develop their style of trading. I would tell you to develop their style of trading because it is more objective and it gives you more of an edge. That's why they have the success that they have. Now, if we take a moment and drop in the stool, 1, because I love it, but 2, because it's really important for people to get this here. At least I made myself laugh. But you see this macro? This is everything. This is our world right now. Okay, so we've gone from, we're looking at the technicals, the fundamentals of companies are really good, but now it's macro. And let's take a look at what we mean by that. Ray Dalio is one of the, if not, I would say one of the best hedge fund traders in the world. His record is just impeccable. It's really very difficult to even judge it, but it's just impeccable, especially the size of money that he moves around. It's hundreds of billions of dollars. And I think that's a very important distinction, especially when you're trading. So he has a very macro outlook on the world, and he looks at the world differently. If you have not read Principles by him, you're missing out. You need to read that book because it shows exactly how he thinks, and that's what I'm trying to get people that watch these videos to do. I'm trying to not only show you what's happening, but how these people think, so that maybe there's things there that you could implement in your life. Just a suggestion. There's now a 50% chance of a world war as the Israeli-Hamas conflict threatens to spread, per Ray Dalio. I think this is very important because we're seeing an increase in this. We're not seeing a decrease. The one thesis that we have out there that we must pay attention to is what is the uncertainty that we can't quantify. And what we're seeing right now is that there is a 50% chance of a world war. If he's talking about this, he's an expert in this field. This is what he does. He determines how things are moving globally, and then he acts based upon it. In my opinion, this war has a high risk of leading to several other conflicts in a different types of number of places, and it's likely to have harmful effects that will extend beyond those in Israel and Gaza. It's not ideal. Primarily for those reasons, it appears to me that the odds of transitioning from a contained conflicts to a more uncontained hot world war include the major powers have risen from 35% to about 50% over the last 2 years. If they spread to other countries, most importantly, the major countries, there will be much more horrific hot world war. It seems to me that Israel and Hamas is another classic unfortunate step towards a more violent, encompassing international war. My more attainable stretch goal would be for the U.S. and China. I want to be real clear about the language here. My more attainable stretch goal, what optimally he would like to have happen. So he has an optimization. This is what would be best. U.S. and China jointly broker peace in Ukraine. He said, based on the perspective I have gained from studying history and over my 50 years of experience betting on what's likely to happen, this is a really important distinction, guys. Don't sleep on this statement. It seems to me that the Israeli-Hamas war is another classic, unfortunate step towards a more violent, encompassing international war. Part of a larger war dynamic. Anyone who studied history and is watching what's going on should be concerned about these conflicts from being contained to an out, brutal war that contains other sides is clearly defeated. These conflicts spreading involve more countries. In order to gain perspective on how these pre-war stages in the big cycle unfold, I suggest that you study other pre-war periods, such as those in the 2 years prior to World War I and II in both Europe and Asia. What is happening now sure looks a lot like that. That is not a statement that I would sleep on or not pay attention to it. And frankly, I'm surprised that he wrote it and it's that bold. So that is definitely one thing that we have to pay attention to. That is a period of uncertainty. I think the uncertainty in that is starting to creep up. And we saw a major change in some movement here, and we're going to discuss that. But most important to us is understanding that that kind of movement, that kind of statement does come from somebody that actually understands this stuff. And also, if he's thinking that, he's not the only one that's thinking that. And that's another important distinction. I mean, he's got a bunch of people that trade just like him that have access to a lot of capital. Now, if we look at the Nasdaq, most important for me is just what's happening here. We have this DTL, we're boxed in here. To me, this is a classic setup, and you're seeing us point down. Again, I'm not going to spend a lot of time just on the technicals today. We're going to really dive into the market and look at hedge fund positioning. We're going to have to really talk about how hedge funds are positioned with the dollar and what does that mean. There's a lot of moving parts to this. And if you're just looking for me to say, do this, wrong video. If you're trying to learn and get better, right video. So if you see how the Nasdaq's wedged in here right now, and then we just overlay the most basic of indicators that I utilize, which is RSI. This is proprietary settings. That's why yours don't look the same for those that ask. And then if you come here and you see how you're riding. Now, this to me was a very important distinction. What do I need to have happen? I need to stay above the 55 for how many days? 3 to 5, just like I did here. Does it always work? Does it always work? No, but you know what? Nothing always works except gravity, as somebody pointed out to me the other day when I tried to explain RSI. And I want to be really clear about that. I use RSI a lot. I got a lot of comments for that RSI video. We're putting it together. I have somebody working on it this weekend, so hopefully it should be out within a week. And it's extremely helpful. I'll actually, if time permitted, I will show you how we used it. We have a new drawing, and I think we should pull that up. And I think we should also thank Steve for the drawings. And the reason for it is because you don't have to see me try to draw a stool anymore. Now I have one. Now I've got this. So instead of me saying RSI is almost as reliable as gravity, now I just have a slide for it. So we've got that going for us. Now you see right here, and you can see what are we doing? We're starting to roll over here, and we don't want to do that. And you can see how we're flipping the 50 right there, right? 55, apologies. So if we're flipping the 55 there, and I need 3 days above at minimum, and this doesn't count. What am I going to do here? What is that telling me? That's telling me I rejected the DTL and institutions are losing interest in the Nasdaq. And I have this right here that is very clearly telling me what? That Below the 55 is what's in charge. So I could argue with the market. I could tell the market that it's wrong. How's that going to go for me? Probably not really well. Or what I could do is I could utilize that bar in making more informed decisions. How would I do that? I could just very simply mark the top of that bar. Let's drop our cool magnet down here. That saves us time. And that'll give us an exact level. Now you know that 15.3, 66.75, if you're out there whacking around the futures, that's your level. That's what you want to watch. You broke the 55. How can you be feeling warm and fuzzy about your position right now? You can't. You can't be. Let's get rid of our guy here. And again, everybody thanks Steve, because now you don't have to see me try to draw that. And I'm telling you, you don't want to see that. Let's get rid of this level and let's look at what's going on. Here's the DTL. I do not like bars like this where we are less than 50% of the bar. I think that's a very important distinction. I think if we take a look at the market overall and just clean this up, we can see, as I like to point out with RSI again, see our level right in here? See how we broke 70 and what happened? Ever since you broke 70, meaning it's not being above that you always have to worry about. You can still trade above. You can still hold what you have above. But when you break 70, they usually put in tops. Now, you might not like to think that, but it doesn't really matter what you like. It really doesn't. It matters what can actually make you money. So if we're looking at that, yeah, sometimes life is that simple. I would pay attention to this. Now, I also just note, you're also not below here. And I will get more into the technicals on Monday on what's really going on under the hood here with rate of change, but we have a lot to go over and we need a broad overview so we can make more informed decisions this week, which is exactly what we need to do. And we can see in here too, like this is not over, right? So if we go here and we clone these lines, always clone your lines, guys. It's real simple. Just clone them, drop them in, and just see what's working. And just play with them a little bit. You don't have to go absolutely crazy in here. All you have to do is just clone them and get a sense of where that channel might be sitting. That's all you're trying to do. You're not trying to reinvent the world. But what you want to do, again, here is we just want to drop that 50% line and go, okay, well, if I drop 50% from here to here, so I take this peak and I take that peak and I come across, well, I think it's really interesting that we rallied, come down, and that's our 50% line. For those that don't know, 50% is not a fib level. 50% is just 50%. Here we are, and now we're locking in there and going, okay, well, where would that take us to? Well, if we were to drop the same way that we think the S&P could drop, let me get off the magnet here, apologies, then that's going to take us here. Okay, so I have the ability to see, in my opinion, a 10% correction in the Nasdaq. I need to be cognizant that that is where I think my risk could be on the market to the downside. That does not mean it's going to happen. Please understand and re-listen to that statement. Okay. What I'm saying is this is a probability. The longer that this goes on and the more weakness that we see, the higher the degree of probability that that does. And I would suggest that you look at things that way. That would be a suggestion that I could offer you, that you look at things that way. In other words, I am not saying because we broke the 55 that we are 100% going to drop down to like 14.6, let's say. But what I am suggesting is that when you break the 55, there is probably a greater than 50% chance that we're going lower. And what I'm doing is I'm assigning a probability to that, and therefore it helps me slowly tweak. For those that play golf, and I don't play golf, you'll know that the difference is in the inches, and that's the same thing you're doing here, guys. We're fighting for inches, guys, in the general sense. About 15% of women that watch these videos, which is 3 times greater than most channels, which is kind of cool, really. So now we understand where we are with the Nasdaq. We understand what's going on with the 10-year. We understand how we're going to view the 10-year to get the most out of it. We should talk about the VIX before we jump into the dollar, because the dollar is going to take a little bit of time to really understand the nuances. Most important thing that I can tell you about the VIX is we could not get back above this level. I would have preferred to get above this level because look at where we're at on the NQ. So in other words, we could not even get to where we were on the 4th. So go back and take a look here and go, well, this is where we were on the 4th. This is where the VIX spiked, and that's all we're going to get out of it. Where is my fear? I've got 2 wars going on. I've got a lot of issues going on, and this is what I'm going to get. Let's get rid of that 55 for a moment. So now what do I do with this? And we really don't need to look at the RSI for a moment. So now do I look at this? My concern is this, and I've said this all week if you go back and listen to this week's videos, and I would not sleep on this week's videos. These are make or break videos for me and the way that I think until the end of the year. I really believe that. You're setting yourself up towards the end of the year. There's approximately 50 trading days left. So if you take a look at the VIX and you look at events that triggered bottoms. We have the regional banking crisis when CPI actually peaked and there was fear and everything was going to zero. What do we have here? I've got two wars going on. We have oil that's starting to creep up, even though people did not think it was going to creep up. And then what we're seeing is we're seeing this come straight across. This is not really where I want to be. I want to be up here at 24, 25. And I want to see how this plays out and where it goes from here. And that's a really important distinction. Really important. I need to get a lot higher on this. Now, in regards to the dollar, first and foremost, this is not my chart. This is Sentiment Trader. I have no affiliation with them. There's no link. I like their product. I like what they put out. Why? Because it's just quantitative data. Sometimes they'll back test it, which I love. But I really like the ability to look at things and quantify what's going on and then see if there's something in some way that I could benefit from it. And we're going to be a little obvious about some of this stuff. Number one, you can see the huge hedge fund exposure here. And you can see that they actually played quite nicely. And we can see how that played itself out. What I see happening here is a little different. And I'll explain how I'm viewing this. First and foremost, you want to watch the lines. They have less exposure when you are down here. They have more exposure when you are up here. It's not rocket science, but let's break it down. So this is how you calculate, or what they're calculating. This indicator is based off composite of hedge fund tracking indexes. It compares the hedge fund exposure against returns, the US dollar, and sees how much exposure hedge funds appear to have in the currency. If they are highly exposed, the index will rise more than dollar, vice versa. We generally see that the funds are heavily exposed to the dollar, then it is in danger of stalling out or failing. These funds retrench. When they're underexposed, then we may see buying pressure as they add exposure. Okay, they're telling you that is a contra trader. They increase, the dollar should drop. Does not always work that way, but I think it's setting up for that, which is kind of interesting. Let's take a look at this, because we know it's not you and I buying the dollar, right? You might be in there, you might trade it around. You're not in there building billions of dollars of hedge fund exposure to the dollar for that trade. Okay? The majority of people that are watching this video are not doing that, I would assume. So if we're taking this and we're looking at where we're at and going, okay, well, this is pretty high if we look over this period of time. And you can see we go back from 19 to here. So we're looking at roughly 5 years. All right, look at the exposure. Look at how the exposure is increasing over time. Look at how it's starting to drop. Well, if we're throwing billions and billions of dollars at something and it's dropping, that's not probably ideal for that position to keep going up. Now, that doesn't mean that it's just going to miraculously drop back down, but how much higher is this going to go? If you look at this historically over a 5-year period, and let's just do it this way so you can get what I'm putting down, you really only have in 18 when the market spiked, when people got used to the fact that rates weren't going to be zero forever. If you look at this level, how many times have you been here? Not very often. And if you even look at the time that you were above it right in here, how much money did you really make on that dollar trade over the course of a year? Very, very little. And then if you broke here, and again, you have to, we had this injection of capital, but if you look here and you kind of see how that's playing out, right? You kind of have that curve that's going right in here. And then we look at this kind of curve. Then we're back over these lines. I love these demarcation lines. They make life so easy. This is telling us something, and it's pretty dramatic. I don't know that this continues. Now, that said, let's get into this aspect of it because I think this is really important. If we go here and we take a look at the dollar and we look at this demarcation line and we see this neckline and we broke it. Now we're trying to rally over it. You don't rally here. I'm not the only technician in the world that's going to look at that. Let's look at this on the weekly. You have 11 weeks of going straight up. Let me clean all this off. And I appreciate your comments about the videos, about allowing them to be a little more raw. It really lets me get more information out to you faster. And right now, the more information that you have to make a more informed decision, the better you will be. I can't be any clearer than that. If you're just looking at technicals, right now, you're going to get torn apart because you're not going to know what's happening and you're not going to know what to look for. It's just really that simple right now. It's a completely different game than this was 2-3 years ago. If we look at these little levels that we just popped in there, let's say we can't get over this 107.5, which is this rejection point, and then we have my favorite kind of bar, which is that gravestone doji right there, and then we break down, and then now what? All right, so we have this tear where every week just buy the dollar, and then we hit a point where they're like, well, not so fast. And then what we always like to do is just take a peek and look at a trough and see if there's anything associated with that. Well, there's 50%. So you have a 50% retracement that's sitting right there. Funny how that works, isn't it? And now people are absolutely exhausted from buying. And now you have what? You've returned to some kind of medium. Mean reversion trading is actually a thing. It does work, but it's not my trading style, but there are a lot of people that will use it, mean reversion. It does work. They'll do it with Bollinger Bands, etc. Anyway, if we look at this, and you can see the undercut right here, maybe it pushes, maybe it doesn't. But I think the one thing that we have to go with here is we didn't make a higher close. Even this right in here, this dragonfly bar, that even made a higher close than the previous day, or it came darn close to it. Let's take a look. 401.18, 104.26 versus 104.18. Dyslexia kicked in there. So you can see right there, even that bar in here, we made, and this is what I'm looking at, guys. Get into it real quick. I just have so much to go over with you before. I notice the time of these videos. If I make them too long, people look at the time and go, oh God, that's enough. That's enough of him. So I'm trying to pack more in faster so that you can make more informed decisions. Anyway, Dragonfly, boom, still over. So what do we have here? Well, we still have a higher close, don't we? How about the day before? That'll be interesting. Or the week before, 106.17. What do you have here? 106.10. This was your first lower low close in 11 weeks. It's a really important distinction. Now, are we going to flip that or not? I don't know. But who's left to buy the dollar is where my head is with it. Who's left? What's going to drive the dollar? What is really left? And that's where my head is. Now, if that's what we're thinking and who's left to buy the dollar, let's say the dollar gets weaker. How do we benefit from that? Well, I'm glad you asked. So the number one group that will benefit from that are industrials. And industrials actually have the inverse trading, don't they? They actually have the inverse trading to what? The dollar. Isn't that interesting that we're seeing that? So as the dollar came down and then tried to rally, what happened to industrials? Well, why is that? Because industrial equipment that's bought across the world is traded in US denominated dollars. So if you want to see if these names beaten down, can we see some kind of bounce in Caterpillar? It's kind of holding in here, isn't it? So this might be something that we might want to be paying attention to. If this gets worse, it's not going to be tech that's going to hold. It's going to be Caterpillar. It's going to be John Deere. They're going to start buying these names. These are the names that are going to start holding. And I just thought this was really fascinating to me when I started to look at this and go, well, we just hit that lower trend line and we held. Now, this looks awful. I mean, the technical term for this is awful, because you have this down bar and you have there, at least I made myself laugh again. And now I've got these bars and I've just got Doji City, which we don't want to play. And I'm not saying you need to buy this Monday, Tuesday. I would keep my eye on the industrials, and not all industrials, like TSCO looks god awful and they're having all kinds of problems, but I would be paying attention to John Deere and Caterpillar. I stay away from Boeing. The reason I stay away from Boeing is every week I'm just afraid you're going to see something else with the 787. If your core product, people are calling the airline to make sure that they're not on your plane, you might have a problem. Okay, that might be something that would maybe be an issue. And this is a huge demarcation line, and you have clearly rejected that demarcation line. But let's keep drilling into this. So we have the dollar, and we're rejecting. We know industrials will benefit from that. We know that the markets will benefit from that as well, right? As the dollar was rising here, what happened? Right? The S&P was dropping. We know this. We've gone through this ad nauseum, right? We've discussed this, and you can actually see the complete inversion of when the dollar was dropping versus the S&P, right? We can see that, how here was just a great time to buy, and this was the worst time to buy. So as the dollar goes higher, our stocks become less attractive to the world. If the dollar levels off, it's good for the US equity markets. So while we're trying to figure out the other pieces of the puzzle, and I have something else. There you go. Pieces of the puzzle. Thank you, Steve. So as we're trying to put together, I must say the same things over and over again because I keep getting these from Steve. And thank you, Steve. I appreciate it. I'm sure everybody else appreciates it too. So if you take a look here and you look at the dollar and you go, okay, well, the dollar's going flat. We can buy the industrial space. And we, quote, start putting all the pieces together as we sit on our stool. Maybe we're getting a little sleepy in here. And maybe that's something to consider. And maybe we have to start looking at industrials, because the way that we're going to benefit here is if this continues to go flat, and if this continues to just revert to that 50% line and come down, just like the NQ, just like we showed with the dollar, and all we're seeing is a reversion to the mean, well, all we're going to get is rotation, guys. That's all you're going to get. That's how you're going to make money. And candidly, when you come out of bear markets, which we've been out of, but when you come out of them, that's what you get. You get constant rotation. So that's something that we have to consider, but there's more rotation going on under the hood that we're going to get into. But our core issue is this, And I apologize that this looks like it's a little cloudy. I think that many people will agree with me the vivid example of the failure of the U.S. policy in the Middle East. Putin. Remember we were talking about escalation? We have to keep this in our heads. We have to realize that no matter what, we're still sitting on that stool. And we're in a position right now where we are on the macro leg more than we are on the fundamental or technical leg. And you don't want to see this kind of rhetoric. This is not what we want to see. This is poke, poke, poke. Putin asserted that Washington is aimed to monopolize the initiatives for establishing peace and critic for not actively pursuing viable compromises. The U.S. has neglected its interest of the Palestinians, including their need for independent Palestinian state. Including their need for an independent Palestinian state. Tell me where you stand. Putin further stressed efforts and engagement. According to the Kremlin, Moscow participated in various diplomatic initiatives, but noted there has not been limited advancement in these efforts. But nevertheless, we intend to keep making efforts and play our role in terms of providing assistance to seek ways to a settlement. The recent crisis aim to maintain a balanced approach, emphasizing its relationship with both parties. Moscow allegedly uses Iran-made drones for its war in Ukraine. That is something we really have to pay attention to, guys. I'm not an expert in this field, nor am I trying to play one on YouTube. But this is something that we really need to pay attention to. You have guys like Dalio. These are not the comments I wanted to see this week. I did think that they were underestimating the risk of this. But the way that this is escalating and the rhetoric that was escalating, we need to start paying attention to this. And I think that we have to just understand that. And then they have ties with Hamas, which has sent a delegation to Moscow in March. It also has a lot in common with Israel, including the fact that many Israelis are former U.S. Russian citizens. Now, why are we reviewing that? Because you have to understand that this is all tied together. So maybe the market doesn't drop, maybe it does. But I think that overall, not understanding that nuance is going to be a problem for people. And what this does is it brings out the gold bugs, and I'm not sure that that's the right move. Now, maybe you caught a trade here, and maybe that trade did exceptionally well. But where has gold gone for this period in time? What really has happened with gold? And let's just go to July and take a look at something. So if I mark July and I mark this specific level on gold, what else do you notice about July 2021? We're really in the same spot. What if I was to take this peak and I was just to drop it at that trough over the same 2-year time period that we just looked at? What? The S&P, the Nasdaq, the 10-year. The 10-year is way off, right? But let's look at this. Okay, so gold hasn't gone anywhere in 2 years. It really has not gone anywhere. All you've really done from this line is either do what? You've either been down 11% or up 11%. That's all you've done in 2 years. So maybe we're digesting this move and then maybe we're going to head higher or maybe we're not. But you need to look at what's going on under the hood. And let me give you an example of what I mean by that. Now, if you've been following this channel for a while, you know that percentages above a certain moving average I look at a lot. They help me understand the market. They help me understand where we are in regards to breadth. What I would point out here is this the right time to be buying gold names? If we look at this, what we're seeing is percentages of stocks above the 10-day average. I want to be clear, this is Sentiment Trader, this is not me. And when we're here, do we usually do okay? Can we buy stocks when they're up here? And the answer is overall, no. No, it doesn't really work. So if we take a moment here and we just do something as simplistic as just mark all these off and just say anytime that we're up here, how on average are we doing? Just at that particular level, how are we doing? We'll even throw this. And then look at it and go, well, we rolled here. Okay, well, this one, if we look right in here, you could have made some money. Okay. Looking at this one, well, this would have just been a monster, absolute monster move. Okay, what was going on in here? We thought we were going to lose the banks, right? Everything's relative. You have to understand what's going on at that time. We have to look at what was actually happening. Remember, there's levels to this. It's not just the technicals that we want to study. We want to know where we were macro, fundamentally, and technically at that particular time. At this particular time, what was happening? Right in here, we were wondering if we were going to lose banks. So, of course, the gold stocks are going to go up. So should we keep this in or not? Well, we should keep it in, but we need to understand why. What was the underlying issue here? All right. Hopefully that makes sense to you. Now, we look here. What's happened? Well, we peaked. What happened here? Kind of peaked. Okay, so we're here. So now we have about 90 to 95% of all stocks above their 10-day moving average. And this is the spot where we're going to go out there and start buying the gold names. That doesn't seem optimal to me. And that seems like something that we might want to point off. Now, I know that's easier said than done when you're watching gold go higher. That's up to you, and everybody has to make their own decisions. But when I look at names like Newmont, that is not something that I'm ready to run into. I will point out this one, this AU, for whatever reason, and I'm not sure what the reasoning is, this particular one just seems like it's on absolute fire. And if there's other little names like this, that you're seeing that are on fire, put them in the comments, let me know. The reason I'm saying that is the way to play this might be to start looking at the smaller, more leveraged names than the bigger players, because the more leveraged names might speed up production. And that might be an edge that we could have in the trade. Hopefully you follow what I'm saying there. So if I look at something like this, I've been watching this one all week. I've done nothing with it yet. A couple guys in the room are trading it, but I haven't done anything with it yet, because if this sets up and gives me a inside week and then breaks out, there might be something there. And if I look at just the most simplest and just throw a MACD weekly on it, I'm starting to cross here. So this one, why I just said that, I think the devil's going to be in the details, and I think it's going to be in the smaller names, and that's just my opinion if I am to look at this. And you know, these guys are a little thin, and so you're going to have to be a little careful here. But I do like what we're seeing here, and I do like the way that this is playing out. So it is something that I'm looking at, but overall, on the gold names, I think we have to kind of take a break here and just let them settle down. Now, another thing we're starting to see more than anything are these little divergences. Now, this is electronic semiconductor equipment. We're going to look at the stocks here in a moment, but I think we should talk about this first. You want to start looking at these subsectors. I use MarketSmith. I have no affiliation with them right here. You can see it's IBD. I'm starting to watch this sector, and this sector looked like it was going to break out. A bunch of people were playing it on Friday, and I just want to talk about what we're seeing. We're seeing a massive rejection, and they use a 50. I'm not going to change it. I use a 55. Use what you're comfortable with. But look at that bar and look at that rejection. Look at that volume. This is not ideal. When you start seeing a roll of something like this and you have this kind of RSI associated with it, or relative strength as they refer to it, you know, they compare this to the other 197 industries that they have, and they give it a number. And I think it's actually very helpful, frankly. But when you start seeing this and you have this little DTL that's setting up this way, I would pay attention to this. This is not ideal. So the question is, why are they getting weaker, right? Or are we going to see less demand because of what's going on globally? I think that's an issue. But there's some other glaring things out here before we get into some individual names. For starters, this is industry breadth percentage above the 50-day. Now, I usually will show S&P names or S&P stocks above the 50-day. And the reason I'm doing it this way, candidly, is because I want to look at different industries. And the way that Sediment Trader does it is they divide it into 23 industries. And right here again, it's Sediment Trader. I just think it's important to know what we're looking at. If you don't understand what you're looking at, you don't know how to use it to your advantage. 23 industries that are trading above the 50-day moving average. Now, we're going to notice a couple things. Whenever you're down here at this level, it's usually a fairly decent time to get involved. So if we just kind of mark off here and we look at the past, I think we went out 3 years on this, and we just look down here, we can see how unusual it is to be in this spot. Then if we just do something as simplistic as just say, okay, well, let's mark here, here, we're here, and we can put a little question mark or something wonky like that there, and I'm just going to stop saying it in a moment. But you get what I'm putting down. So we're in this box, and of course this is the pandemic. Has there ever been a time when this has been in that box where 3-4 months later it has not been higher? Let's just say a month later, has it not been higher? I would say that every month that we could look at, it's been higher. It doesn't mean that you're going to do this, but it does mean that, you know, the chances of you doing something like, you know, this, and then you're up, down, up, that's more realistic looking at this. So when I look at something like the semiconductors and we talk about the equipment manufacturers, I think there's a really important distinction we need to make here. Am I on the tail end of this? Right? In other words, what do I mean by that? Well, if I'm down here and we're going through 23 sectors, are they throwing in the towel on the last bit? Right? There's a saying, we always come for the generals last. So are we coming for the generals last? Meaning, are we going to start hammering the Apples, the Microsofts, the Googles, and then we rally? I don't have an answer to that, but I will say this. You have to look at what's going on globally. We have to pay attention to what's going on out there, the escalation that's going on out there. But at the same time, we have to look at all these pieces and say, all right, maybe the dollar is going to slow down. Maybe we are completely oversold here on an industry breadth basis. And maybe that's why the equipment manufacturers are starting to roll. Now, that doesn't change the fact that I don't buy things on swing trades when they're under the 55. But it does mean that I need to be cognizant of why. And let's be really clear about this. This is everything. What's going on? Now, they're talking about a ground offensive in Gaza. They were talking about 1 million people possibly being displaced. This is absolutely huge. Egypt closed their borders. So this is starting to accelerate a lot. And what we're afraid of is when Hamas had this attack, which obviously killed hundreds of civilians, the ground invasion is threatening to draw in Iran-backed Lebanese militant group Hezbollah from the north. U.S. has deployed 1 aircraft carrier to the region. This becomes an issue as we go back and we look at what Dalio said. We do not want this. We do not want a widening conflict. We do not want Iran involved. And that leads us to here. Large trader put buying, sentiment trader. Look at where we're at, look at where we've been before, and then look at how we've acted in these areas. What's the difference here? Large trader put buying. What we're looking at here is we're looking at the big boys. And they define the big boys by anyone that's buying 50 contracts or more. This ratio looks at transactions that are buy to open only. Very important distinction than most indicators out there, over 50 contracts. It monitors the trading in large traders. One indicator is constructed by computing the percentage of large trader option volume that went to buying put options. It's proxy for hedging activity on a market decline. The possibility that many large traders may be, quote, smart money, as we know, we refer to that as institutions. High-level put buying tends to be a contrarian indicator and is bullish for stocks. And that folds back into what we're talking about here. Are we on the tail end of this? If all the industries are below, so you take all the industries and they're below where they're supposed to be, they're coming for the winners right now. We saw that on Friday. They came for NVIDIA. They came for Apple. They came for Google. Right? They came for Microsoft. We saw this. We don't need to go over it. And now this is where we're at. I think that's a really important distinction. I also think that what people should look at is people say, oh, we're not as high as we were here. I think that's the point. I think you're seeing exhaustion in put buying. Well, that starts to happen. The only thing to do next is for that to start to unwind. And if that starts to unwind, that this could get pretty ugly. So are we on the tail end of this? And the answer is we just don't know yet, but we are seeing signs of that. Now, at the same time, I'm telling you that we're seeing signs of that. The NDX, which is the Nasdaq 100, which I look at a lot, but I obviously don't trade it. But I want to know, what are the top 100 names in the Nasdaq doing? Because these are the growth drivers. Well, look at what's happening to me right here. I'm breaking below my 55. Did not get 3 days above it, but we already know that. And that's happening on the big dogs. So do I want to be the guy that's saying, okay, well, this is slowing down, and because we're slowing down because of the put buying, because of all that put buying, because of where we are with all those indexes, do I want to be jumping in here? No. What I'm saying is I need to be cognizant of what's happening. I can take advantage of it to the downside, but I have to understand that that downside might be limited barring an escalation in the war. That's what I have to be cognizant of. And I have to put all of these pieces together. I won't show you that graph again for time's sake, but I have to put all these pieces together and come up with that game plan and say, yeah, right now, yeah, I could see being a net seller of tech. That makes sense to me. Maybe we play some bounces if some names get to support levels. We did some of that on Friday. Some of it worked out very well. I think we have to look at that and say, okay, that's just where we are, and this is what I have to deal with. This is the hand I'm dealt. Now, in front of us is hedge fund exposure to bonds. How much do hedge funds own bonds right now? And this is where we're at. Now, what we're going to do is just something very simplistic. And just let me do it this way. Let me clean this off for a second. What I want to do is I just want to do something really simplistic here. I want to just take from this line over down and just look right here. Look at what we have right here for a moment. That's been the worst. That was 18. That's when they threw in the towel. This is when they threw in the towel and they said, we don't want to own any bonds. How did that go later for the bond market? If you take a look at that level when it was one of the worst times, how did that go for the bond market? Bond market absolutely exploded from there. You start looking at where we're at now and you have to say to yourself, are we in that same situation? I don't know. The only thing I know is that it's very rare for us to be this low. Matter of fact, if we were to even take a look at this and say, okay, well, from here down, how often do we get here? In 10 years, how often are we at this range? And it's not really very often that we're in this particular situation, that we are this low. And if you look at it from this perspective, you would almost think that it's a probably pretty good time to look at buying the bond market when hedge funds have very little interest. Does that mean that we should do it blindly because of that? No, but it does mean that, let's say that the war escalates. Let's play devil's advocate. War escalates, things at home start getting a little weaker. Fed says we're not going to raise rates, which they've already alluded to, that they're not going to raise rates. We're not going to cover a lot of that today. Okay, what's the next move for the Fed? The Fed's got to do something. So eventually down the line, 6 months from now, what are they going to do? They're going to cut rates. What's going to happen to the dollar if they cut rates? It's going to roll over. What will happen to industrials? See how this is all connected? And by understanding these pieces, it allows you to make better decisions and not be as reactive. And that's what you have to focus on. And you're starting to see them put more money to work. They're definitely putting more money to work, and they've been through all of 2023. Now, what do I mean by they're putting more money to work? This is New York Stock Exchange margin debt on a percentage of growth. This is the definition. This indicator is based off composite hedge fund tracking indexes. It compares this index of hedge fund exposure against returns to the 10-year Treasury note and sees how much exposure hedge funds have to the bond market. This indicator shows the 12-month rate of change, percentage, and margin debt among U.S. investors. 12-month rate of change, let's get my line, 12-month rate of change against percentage and margin investors. Okay, so now we know what we're looking at. They're increasing and they've been increasing. So when we're looking there and we're saying, oh, we're definitely going to have to collapse, the market's definitely going to come in. If they start putting more money to work, that means every time we drop, the probability of us going lower and lower is probably not ideal unless we have some kind of event. And if we do have an event, well, and that would be the escalation of war, that's really everything right now. But they're putting money to work, but we have to understand where we're at. And there's a couple other things that I think we should understand. Number one, gold versus the TLT. They are buying gold, period. They are buying gold versus the 20-year. That is not stopping. So one of the best trades of the year, which really nobody is talking about, if you just come here and take a look and you mark from this date on, let's say you took the open of the year and you said, where am I? And you're right here, okay? And you're at 19%. That's what you've done on the year. If you shorted the 20-year and you bought gold, you're up 19% on the year. This does not look like it's going to change. That does not mean you buy gold. That does not mean that you short the 20-year here. That means that this trade is telling you that gold is the preference right now versus the 20-year. What you do with that information is up to you. I know what I would do with it, but what you do with it is going to be up to you. I would say that this is something that is worth paying attention to. Will this revert? Of course, everything always reverts, but it's not for now. Take a look at IPOs. We've seen a lot of IPOs come out recently and they're not holding. And I always look at this for health of the market for new issues. Well, this is not really holding very well in here. If we take a look here at IPOs, and this is just the IPO ETF, but it's a great way of looking at the market. Look at how you can't get over. Look at how you tried again, and what'd you get? You got Matumboed right where we always talk about these levels. You got hit right in here, arrow. You can see you got hit right here over and over again. I think that's an important distinction. They're not doing well with the new issues. That's another problem for the market. That means the market in and of itself is at this particular time not healthy. Then we look at commodities, and this is a great, you might want to just write that down, but this is a great commodities index. And we can see what we're doing since the beginning of the year. And that's just a very simple 55 in there, but there's the beginning of the year marked off, comes down, retests support, holds support, flips the 55. Do you think you want to be looking at commodities? The answer is you probably want to be looking at commodities. And then we dive into the sectors, and we start looking at the sectors. And I think that's a more important place to spend our time versus just looking at individual names. I mean, you could always sit here and go, okay, well, what's an energy that's breaking out? And you start looking at the names like HES, and you start to see those turns and start looking for stocks that are above the 55-day moving average. You might want to remember that. You might want to replay that one part right there. And then you could start putting a list together of those kinds of names. Hey, who's above the 55 that's in the top sectors right now? How do I know these are the top sectors? Because I just showed you how 23% or 23 different sectors are down or industries are down. We just talked about how they're going after the other industries. And what are we starting to see with XLA? It's above the 55. If you look at the top 11 industries, there's only 3 that are above their 55 right now. It's XLE. This is definitely something that you have to pay attention to. Does it make more sense to look at this and the commodities, or do you want to go out there and buy DFEN, which has done absolutely nothing, right? Everyone's like, oh, you need to go out there and buy aerospace defense. Only a few of these names are going to move, guys, and it's going to be the big dogs. And that party will end in a heartbeat the moment that this ends or shows any de-escalation. Just understand that. I'm not saying not to trade those names. I'm not even going to cover them, but just understand that music ends fast if there is de-escalation. Does it look like there's going to be de-escalation? No. But when it does, the music stops and you pull out the chairs. Look at XOP and what's going on here. We're above the 55 SMA. So again, you could drill into these names. You could take a look at them. You could be looking at the 3X ETFs. You could be looking at Gush and what's going on there. Maybe that makes sense. That's above the 55. So then you would just keep doing this and going into the names. How about Oxy? I like buying Oxy down here more because I know this is where Buffett buys it, and it just makes more sense to buy along with where the billionaire is buying the stocks. But you can dive into these names and you might find something else. You might look at RIG. I'd wait till we're above that 55, but you can still go through the names and see what you can find. Some people are going to be playing the bigger guys. I'm not so sure that that makes sense. What I started to see was a little bit of rotation, and it started to bother me a little bit. So this is something that we bought on a breakout and did very well with, and then you start seeing these gravestones. So do I want to be a buyer up here of some of these names? No. I think you're going to have to go through these one by one and judge them individually. And for me, maybe it's not worth the effort to do that, and maybe the effort is to get involved here and just do the 3X ETFs. I certainly would not be looking at coal names. I mean, I've been pretty vocal about this, to not be buying this rip. I'm sure people did exceptionally well. I hope they got out before the music stopped, because when the music stops here, it stops, and it's ugly. And we can see that pretty clearly. Coal names are not where you want to be. So all that said, and we have one more sector that's trading up, and we have one sector that is above the 55, and that's XLC. And this is where it gets really interesting, because this ties it all together. What have we been saying? We've been saying that, are we near the tail end of this? Meaning, is this the tail end? Maybe. Then we go into names like Google. Okay. Well, Google's had a massive run, but you're way off your 55 right now, and we've consistently held the 55. So is that next? Is the test of the 55 next? No idea. But if they're going to come for the generals last, and we're talking about all the indexes being down so low, and there's only 3 left, doesn't it make sense that they come for these names next, the Google, the Metas? Doesn't that seem to make sense that they're going to retest these levels, and that maybe that might be the end of this if the war does not escalate? That's it.